Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Partnership Shareholder Agreements 101. Before we begin, we need to cover a few important items. First, please close any other programs that you might have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. Terry, if you could turn to the next slide. This will list the requirements in order to receive your credit you must complete too. First is that you have to do all 4 of the polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in these polls. Now, partial credit will be given for those of you who answer 3 out of the 4 polls. You'll receive 1 CPE credit. The next requirement is that you complete an online evaluation. Today, that will appear on your screen right after the webinar ends, so please do not close your browser before you've had a chance to complete that survey. Once you've met both of these requirements, I will email your certificate to you within 10 business days. Now, in order to fully participate in the webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. You'll see that on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the panel. During the presentation, all participants are muted, but you can communicate with us by using the question box. It's toward the bottom of the panel. Just type your question into the box and click send. If there are any questions that we don't have time for during the session, Terry will address all of those in the follow-up email. Now today, Terry will also be sharing his webcam. So you'll see both his slides and the webcam on the screen. There's a little icon in the middle of the 2, and that will enable you to resize them. So you can choose which one you prefer to have larger, smaller. You can make them the same size. You can even close out one or the other if you find it distracting or wish to just focus on one. Finally, I'd like to remind you that Transition Advisors offers a free CPE webinar each month. You'll see there our next 3 sessions, which are all open for registration on our website. So July 27th, Alternative Deal Structures. We'll do Growing Your Firm Through M&A on August 17th, and then a 2 CPE class, so that'll be Succession Planning and Valuing Your Firm, and that's on September 28th. You can go to transitionadvisors.com and visit the CPE courses section to find more information and to register for those. Now, as a reminder, you did receive a link to the PDF of the slides in the email that you got earlier today. I also just sent it via the chat function, so if you'd like to download that PDF and follow along, you're certainly welcome to. And now I'd like to go ahead and introduce our presenter for today. Terry Putney is the CEO of Transition Advisors. Thank you all so much for attending, and I hope you enjoy the webinar.
Hi, everybody. I'd like to first introduce Transition Advisors in case you are not familiar with us. We're a national consulting firm. We work strictly on issues related to the ownership and transition of ownership in CPA and accounting firms. That involves, to a great extent, working on mergers and acquisitions. The other big area that we work with is ownership agreements, which is something that I'll obviously be focusing on today. And you know, we support M&A all the way from the finding the partners, finding the parties to introduce, all the way through to closing. On owner agreements, we work on succession planning, the business plans that back up the succession planning. And whoops, I think I shut off my webcam. Sorry about that. What is going on here? And then also, you know, help drafting of the actual drafting of the agreements. I'd like to encourage you to ask any questions that you have today through the chat room. If you send me an email at the end of this, after the presentation, and I'll answer whatever questions you might have about your own situation, and if there's something we can do to help you beyond that, I'd be happy to talk about how we can do that as well. We're going to use throughout the presentation today an example firm. This is actually based on some real work that we've done, and we'll use this as a way to sort of demonstrate some of the tactics and issues that we deal with when it comes to partnership and shareholder agreements. The firm that we're talking about is a a 4-partner firm. They already have 4 partners and about $5 million in fees. The 2 senior partners own 45% each of the firm. The 2 younger partners own 5% each, and they were admitted for $100,000 each at when the firm was $2 million in volume. And in fact, that's how $2 million times 5%. The issues come up. The reason why this is all now the 2 senior partners are, one is 2 years away and the other is 4 years away from retiring. They know they need to admit new partners. They've got a couple senior managers that are ready, and all of a sudden now the younger partners are questioning whether the whole plan's going to work, let alone bring the new partners that are going to be coming in. You know, the partner agreement is based on 1 times actually this is a typo. It's based on 1.1 times revenues times the equity plus capital. So the 2 minority partners are balking at the cost of buying out the majority partners. You can see that 45% of $5 million times 1.1 is a pretty significant cost. And the 2 partner candidates are balking at what they've been offered, which is the same deal that the 2 younger current minority partners were offered, which is a 5% interest in the firm, which will cost them roughly $350,000 all in. With that, we're going to go to our first polling question so we can get an idea of who's on the line and what your issues might be. Nikki?
Okay, sure. That first polling question's on the screen already. How many equity partners do you have in your firm? We'll give everyone just a few seconds to answer this first question. Okay, it looks like we've got nearly everyone. I'll go ahead and close the poll, share the results there. 61% have 1 equity partner, 37% are in the 2 to 4 range, and then 2% of attendees in that 5 to 9 range.
Okay, so that tells me that obviously most of you that are on the call today are interested in probably admitting new partners, and that's going to be a focus throughout this presentation. Especially at the end, we're going to talk about some techniques for how to admit new partners. I assume that it's driven mostly in your succession in your firm. Let me move this. All right. So the objectives for your agreement, these are the things that are the primary overall objectives that need to be addressed in your agreement. One is, of course, the governance of the firm. The real big issue, of course, is managing the transition and buyout of retired partners or any partners that are leaving under other circumstances such as death, disability, termination, quitting, and one that a lot of firms don't think about until it comes up is divorce. You know, what happens if one of your partners gets divorced and all this attorney is trying to control the value of the firm, the value of that partner's interest, and maybe even take over some of the partner's interests. So admitting new partners, of course, is a big issue, and of course that's going to be on the top of mind for many on this call. And then the use of your owner agreement in mergers and acquisitions. Of course, your owner agreement is actually the currency that you're going to use for the firm that you acquire in the case of admitting new equity partners into your firm. So what's your firm worth? You know, this is a question that we get that's at the top of mind because of what we do. In every presentation we do, what's the multiple? What are firms going for these days? What is my firm worth? What should I be paying for a firm? You know, it's really a big issue in terms of owner agreements, of course. How much should you be paid when you're ready to retire? How much should you pay a retiring partner? And how much should you charge new partners that come in? Of course, those are all top of mind, I'm sure, for all of you. When you think about the value of your firm, the first thing you need to do is break it down into 2 pools. The intangible assets are the assets that most of us think of when we think about the value of the firm. So when I say this or some other multiple of revenues, what I'm talking about normally is the intangible assets. That's the goodwill, that's the client list, that's the book of business, the value of your employees in your firm, the brand value, everything that goes into the blue sky of the firm. And the tangible assets are an additional pool of value And that's basically, if you think about your accrual basis balance sheet, that's your tangible assets. So, that's of course what your cash on hand and the value of your equipment and furniture and so forth, which normally doesn't have a lot of value. But most importantly, your accounts receivable and work in process is the biggest component of the assets normally on your accrual basis balance sheet. And then, of course, that's net of any liabilities that you've got to third parties. So this is a critical issue because most firms, the problem most firms get into is they don't make the distinction between the value of the intangible assets and the tangible assets in allocating value between the partners, and then most importantly for bringing in new partners. So one of the things you're going to find is as we go through this, I'm going to make a distinction between how we value and allocate intangible assets and how we value and allocate tangible assets. So when we talk about the intangible value, which is where most of the value is, in most firms this is going to be as much as 3 to 4 times, maybe 5 times the value of the tangible assets. The intangible value is made up completely of relationships. Without the clients, without the employees, there really is no intangible value. So, but there is also no value if those relationships can't be transferred from a current owner to another owner. So most of us, think about revenues, again, as an example. But the reality is that if I can't transfer the relationships that make up that 1 times revenue to someone else, my firm has no value. So the most important issue in establishing value, maintaining value, and building value is to make sure you understand that there has to be a business plan in place, and it has to be properly executed for those relationships to go from you to someone else, whether that's an internal transfer or an external transfer. The problem some of us run into is not thinking this through and thinking it's no different than selling a bushel of apples. Is it an apple and an apple? Well, each of these relationships, of course, is unique to you, and you're in control of them at the moment. And the important issue is understanding how to transfer those relationships. So the key to maintaining intangible value in an internal valuation, in internal succession, is making sure you've got the right people in place to transition those relationships to. So that's making sure you've got a strong succession bench, you've got people capable of taking on the work, giving the transition plan enough time to be executed. And as you'll see, we normally think that a minimum amount of time is at least 2 years. The longer the transition period, the longer the transition plan, the better the execution tends to be, and making sure that in fact it is properly executed. I'll give you an example. This just happened this morning. I was talking to a sole proprietor. This fellow has a very unique practice. It's about a $3 million practice. And he has 3 non-equity partners, one of which is potentially his successor in the firm. The real issue, and the reason why I spent almost all my call with him today talking about this, is that it doesn't make any sense for us to put together an owner agreement for this firm if he doesn't have the right succession bench in place, if he doesn't have the right plan in place for how to transfer these relationships. I can put together a shareholder agreement for this firm easily. That's not a problem. The problem is the real business plan that backs that up. And that's where we always start in the projects that we're involved with. Your value is actually made up of a package of terms. The most important of those issues or those terms are, first, whether or not the buyout is going to be contingent or whether it's a fixed obligation at the date of retirement. I'll tell you that most agreements, and especially the larger the firm, are normally fixed at the date of retirement and not contingent. How long the period of payments is going to be. Most agreements internally, and in fact this is the case externally as well, do not carry an interest factor. So the length of payment is an important issue in determining the value. So obviously a payment stream that's 10 years is going to have a different value than one that's 5 years. But the real issue there is the cash flow. It's because we're normally paying for the buyout out of profits, and the quicker we're trying to pay it, the more of those profits we have to use to do it, the less the cash flow, the less likely the plan is to succeed. So the period of payment, the term of payments is an important issue. Certainly the tax treatment, that can run anywhere from a deal that's completely, or buyout that's completely deductible as paid, as most agreements are set up, all the way through to one that's totally non-deductible. If you're in a corporation, of course, and you try to do the buyout strictly as a stock buyout, it's non-deductible for the payor, and as a result, has a completely different impact on the value. And then a core determination of the gross values should be the result of those other factors. So as an example, a deal that is completely non-deductible as a stock purchase might carry a very low multiple as a result of that. Say, if we're comparing it to something that's at 1x, maybe we'd be willing to pay 0.5x because we can't deduct any of the payments. If, on the other hand, if we're paying in a partnership form, where we can actually create a capital gain transaction for the payee, and I'll talk about that in a minute, how to do that. The payments would be deductible over 15 years as amortization. Maybe in exchange for that, we would lengthen the period of payments to, say, 10 or 15 years as a result of trying to match up the deductibility with the stream. With that, Nikki, I'll kick it back to you for a polling question.
Okay, the second polling question is on the screen. This one is, does your firm have an owner agreement? So your options here are yes, and it's signed by all owners, yes, but not all owners have signed it, no, you need one, no, you're not sure you need one. Again, this is our second of 4 polling questions. All 4 are required for 1.2 CPE credits. At least 3 out of the 4. 3 out of the 4 would get you 1 CPE credit. Okay, looks like nearly everyone's voted. I'm going to go ahead and close the poll now, and I'll share the results on the screen. 50% say they aren't sure they need one. 32% do have one, and it's signed by everyone, and the remaining 18% know that they do need one. They do not have one.
Good. Okay. All right, so this is one of the biggest issues we run into, both in external deals, sales and mergers, as well as with owner agreements. Why are external acquisitions almost always contingent? As we work with sellers in a transaction, oftentimes they reach the conclusion, hey, I'm taking all the risk here. If the clients aren't kept, I'm the one that suffers. Why do I have to take all the risk? Why isn't the buyer taking that risk? Aren't they the ones that are going to make a difference as to whether or not the clients are kept? And the reality of that is that actually both sides have an important in whether or not the clients are kept. It's the same way internally. If you're going to transfer a client relationship to one of your partners or to a new partner, if that person isn't capable, isn't interested, isn't motivated to keep that client, needless to say, the chances of keeping him aren't very good. So the first thing is making sure that you've got somebody in place who actually has the motivation, that has the skill set, that has the capacity to do this. The issue with external transactions is that those relationships belong to you now, and the buyer has no prior relationship at all with those clients. The buyer's not in a position to assess how easily or how difficult it's going to be to keep those clients. And so buyers that actually take on deals that are primarily fixed at closing, whether that be 100% fixed, which is pretty rare these days, or whether it's substantially fixed, which means that there's very little downside protection in the case of loss of client revenue. Those buyers tend to look at it and say, gee, this is kind of a shot in the dark, if they know what they're doing. This is kind of a shot in the dark, and maybe I should value the business at a lower valuation in order to factor in all that risk that I'm taking, because I really don't know what I'm getting into here. So that's the reason why most external deals have a contingency factor, whether that be a short-term contingency of, say, 2 years, or over the entire payment period, which might be stretched out for 5 or 6 years. Contrast that with an internal transaction. In an internal transaction, we're not asking the clients to take as much, to undergo as much change. The only thing that's changing for them is their relationship with their relationship manager in the firm. And normally we're given, if we do it right, we're going to give that client 2 or 3 years or even longer to go through that transition in a slow, gradual manner, with making sure that the person who's currently responsible is actively involved in that transition. The firm name's not changing, the way we operate's not changing, typically the location's not changing. Most of the things that define the client experience aren't changing. That's one reason why internal deals tend to be fixed at the date of retirement as opposed to contingent. But I do run into situations where it's appropriate not to fix the obligation at the date of retirement. And those situations tend to be, there's a particularly large concentration of revenue in one client relationship. I'm working with an owner agreement right now where it's a 2-partner firm. They do about 1.6 million in revenue, and roughly 800,000 of that revenue is one client relationship. So needless to say, even though all the issues still apply to that situation with respect to a proper transition, if the firm loses that client for something they had no control over, the client sells or outgrows them or something else, there's no way that we can stomach the financial risk that poses for us. Another situation are circumstances where there's a specialty, for instance, and we don't really have in place someone to replace a particular partner that had one partner who was a IT specialist in an area, and they had no one there that even close to the partner level that could replace that partner, and there was no reason to assume that if something happened to him that we'd be able to retain the business that he was responsible for. So we had to make actually his buyout contingent, whereas the rest of the firm's partners' buyouts weren't contingent. If you can get to it and you can become comfortable, it's much better to work with an owner agreement where the buyout is in fact fixed at the date of closing. What I found is that when they're contingent, there's no motivation on the part of the firm or the partners to create a strong transition plan, and they sort of wait and see what happens. And as a result, the transition plan can be very weak and result in poor retention of clients following a retirement. Tax treatment is another big issue. Corporations, are great, especially S corporations, for managing your firm on an annual basis from a tax basis. I understand that. You can avoid payroll taxes and so forth. They're a disaster when it comes to dealing with owner agreements. The reason why is that you really don't have any choice as to how you pay out the buyout of a partner. All you can really do that makes any sense is deferred compensation, which is going to be subject to payroll taxes and subject to ordinary income treatment. Partnerships, on the other hand, do have more flexibility. We can use a code section called 736B, which allows us to acquire a partner's interest in the firm as opposed to 736A, which tends to still be a common way of doing it. 736A is basically treating the payments as retirement, and therefore it's ordinary income. But even then we can avoid, if we do it right, the self-employment taxes on those payments. 736B allows us to actually acquire goodwill from the partner and create a capital gain transaction for the partner. And so we just find much more flexibility when it comes to partnerships than we do with corporations. There is a window of opportunity in some situations, and those of you that are in sole proprietorships, if you meet certain other circumstances, can potentially create a one-time opportunity to sell personal goodwill to the corporation or to your partners. There's some rules you have to meet to do that, but it does allow you to create a capital gain transaction in a situation with a corporation where normally you wouldn't have that availability. Okay, valuation methodology. There's basically 4 primary methods that firms use for determining the intangible value in the firm. Again, we're talking about just this intangible value here. The one that's the most common still, although it's falling out of favor because it creates other issues, is the one that our example firm is using, and that's called the equity method. In the equity method, and this is most of us think of how we do this, it kind of naturally falls towards the equity method. So we determine a theoretical value for the entire firm. Again, let's assume it's 1 times revenues. And then we have somehow determined that each of us owns a certain percentage of the firm. So if I own 30% and we've determined the overall value of the firm is $2 million, then I've got a $600,000 intangible value. That's still used by about 27% of firms based on the external surveys that have been done. And those surveys tend to be focused on a little bit larger firms. So I think when you look at the smaller firms, you find probably a higher incidence of equity method, as well as the book of business method. The book of business method, rather than allocating that theoretical value for the entire firm based on the equity of ownership, is we allocate it based on managed books of business. So, many firms that start off new either start off with partners that kind of are equal, or maybe we determine equity based on beginning books of business. But a lot of firms just say, look, let's just pay you for what your book of business is, just like I would buy a book of business off the street. And we still have about 1 in 6 firms that use the book of business method. There are some the culture that creates is obviously has some limitations, but I still run into a lot of firms where that's just the way it is. About 25% of all firms use a multiple of compensation, and that multiple these days tends to run between 2 and 3 times. We oftentimes will define compensation on an average bias 3 of the last 5 years. And if I've been making $300,000 and we're using 3 times multiple, my intangible value is now $900,000. And that, if that was paid over 10 years, I'd get paid $90,000 a year, plus my capital account. There's an increasing use, and we're going to talk about this in detail at the end of the presentation, towards the end, is the AAV, or unit method, which is really a hybrid of the equity method. What it does is it divorces or separates the allocation of the intangible ownership. So I might own, 20% of the firm, but I don't necessarily own 20% of the intangible value. That percentage is determined in a different manner. It gives us a lot more flexibility with dealing with admitting new partners, and with, as the firm grows, allocating the value of that growth to the partner group. And then the other, about 25%, use either a fixed sum, every partner gets paid the same amount. Some firms are still paying, all we pay is capital, we don't pay any kind of intangible value, or some other method that people come up with. We're all accountants, we all know how to work spreadsheets, so we can come up with some pretty crazy stuff sometimes. One of the things that's surprising is what the average valuation of intangibles to revenue is based on the surveys that have been done. These are pretty consistent nowadays. Firms that are over 20 million, I don't think we have any of those in this group. The average is about 73%. So even though we might determine our intangible value based on a multiple of compensation, if we take what that intangible value is and divide it by the revenues, that's how these percentages are determined. You can see even the firms that are smaller firms that are under 2 million aren't even at 1. One of the things that we need to come to grips with sometimes is why in an internal valuation the valuation might be lower than it would be in an external valuation. For those that are using the compensation method, about a third are still using 3 times. This was historically what was normally the multiple, and the genesis of that is that when you think about our standard sort of tried and true, a third of revenues go to paying overhead, a third go to paying personnel, and a third go for partner profits. 3 times a third is 1. So, historically, again, we've always thought of valuations being around 1 times revenues. We break that into compensation multiples. That's how we got 3 times compensation. But the trend is clearly down, as it is with all internal valuations and even external valuations these days. and that's primarily driven by the fact that there's so many partners that are reaching retirement age in our profession that honestly it's hard to, firms are trying to deal with the financial burden that creates by reducing valuations. About a fourth of the firms are now using 2.5 times, and you can see the percentages for the others. I've seen as low as 1 times. I think that's too low. I've seen a lot of 1.5s, but normally we're talking 2 to 3 times nowadays. So why is it that an internal valuation should be less than an external valuation? Well, one of the big issues is an internal valuation is in effect a put option. If you're familiar with that kind of security in the stock market, the put option allows you at a certain point in time under certain conditions to make somebody buy your stock from you at a certain price. And that's in effect what your owner agreement is. Your owner agreement says that you meet these conditions, I have to buy your stock, I being the firm. So therefore, just like in a put option you might buy on the stock market, you have to pay a premium to actually own a put option. You have to pay somebody to have that contractual obligation. In this case, the way you pay for it is through a discount. So the fact that we're not having to go to the open market, we're not having to negotiate with firms that we don't even know at this point. We know if there's a sum certain we're going to be paid, that's worth something. It's worth a discount in the value. Another issue is the lack of retention adjustment. We're going to do the best job we can to create a transition plan, but there's still risk. And the fact that the obligation is fixed at the date of retirement also justifies somewhat a discount. And really important in this is also the legacy discount. If your goal, and those of you that are sole proprietors are now asking yourselves, or have been for a while, I'm sure, am I better off trying to do it internally or should I just sell? If your only goal is to maximize the value you're going to be paid, maybe you should do an external transaction because you're probably going to get paid more. But you're going to get paid by somebody who probably has more assets and more wherewithal than if you do it internally. The reason why you do it internally is for intangible reasons. You don't want to go through the change of having to merge into another firm. You want to leave a legacy. You like the slow, gradual approach to it. And so, doing that obviously can come at a cost. And one of the things that often comes, the cost of that might be a lower internal valuation. So whereas an external market might still be for many firms that are at, say $1 million and less in volume, still be at 1x in many markets. An internal valuation is likely going to be at a lower multiple than that. I'm going to kick it back to Nikki for our third polling question here.
Okay, third polling question's on the screen. This one is how many partners in your firm will likely slow down over the next 5 years? And here the options are none, all, most, or some. I'll give everyone just a little bit of time. Third of 4 polling questions today. So I've got a few votes coming in. All right, that's nearly everyone. I'll go ahead and close the poll here. So 38% say some, 35% none, 17% all, and 10% most.
How many were all?
All was 17%.
Okay. So you've got issues. The firms that say all in the next 5 years. You need to obviously deal with this. And I assume that a lot of those are the sole proprietors on the call. So let's get back to our example firm. Again, the agreement that they currently have is that the obligation is fixed at closing, which is normal. It's based on an equity allocation at a 1.1 multiple. The 1.1 is higher than market these days, less than, according to the PCPS survey, most recent survey, less than 10% of firms have a higher than 1x multiple these days. The payment for the intangible is going to be over 5 years. I mean, these guys are thinking, okay, that's what if I sold my firm, it's what we bought practices at, it's what everybody else buys practices at, right? 5 times 20, 5 times collect, or 5 years of 20% is 1x. That's how we buy firms. They were clever in that they came up with this as an asset sale under Section 736B so they can get capital gain treatment. And the accrual basis capital, which is mostly made up of receivables, is paid by the end of the first year. That's kind of nothing about that looks that unusual. Kind of is like what you'd expect if you sold the firm, probably. So why is it that the younger partners and the new partners are balking at this? Well, they feel like it's unaffordable, and we'll show you why it is in just a minute. When you assess affordability, and this is a very key issue in addressing your current agreement or in addressing an agreement that you build, you need to make sure that you're rewarding your current partners, your senior partners, fairly for all their years of sweat equity. But you can't expect the people left behind to either go out and borrow a bunch of money or take less compensation while they're paying you out. That's where you run into the problem of affordability. And so, how do you do that? Okay, the first thing we need to do is understand that the capital that we have available for your buyout is the compensation you used to take out of the firm. If you say to yourself, well, aren't I just paying for my own buyout? You're right, you are. You're being paid with the money that you used to make, but you're now no longer working. It's not like you haven't gained anything from it. You gain the independence of not working, obviously. But that's the capital that we have available to pay you off. So there's three things we have to do with that. The first thing we have to do is we have to replace you. What's it cost to replace you? And that can run, needless to say, we're not going to go out and hire somebody just like you with the experience you have and so forth. So hopefully we can replace you for less than we're paying you now. We have to be able to pay you off. The terms of the agreement obviously will dictate that. And we ought to have some upside left behind for the remaining partners so that they don't feel like they're just running in place for the next 5 to 10 years while we're buying you out. But there's actually some upside in it for them. And plus they need room. So let's look at the analysis. Let's say we've got a retiring senior partner who's making $550,000, and that's in fact the case with this Elder and Golden. With benefits, that the actual compensation package for the senior partners in that firm was $600,000. The replacement labor we decided and agreed to was about $150,000. Now, how do we come up with that? Well, the minimum amount of replacement labor cost is going to be associated with their billable production. So if you're producing hours at $250 an hour, that's $300,000. Typically, the cost to replace that production for non-partners is about 40%. So in that example, it's about $120,000. In this case of technique, we decided it was about $150,000. Now, obviously, we're not at that point addressing the cost of replacing all their other duties and responsibilities. And hopefully, the partner group that we've created to stay behind can absorb those other administrative costs, non-billable tasks without any additional cost. If there is some, we have to factor that in. But we're not going to be able to replace the billable hours without somebody working more hours or without us hiring more staff. So in this case, the maximum amount of financial resources we have available using my formula is about $450,000. In this case, the firm volume was $5 million. We valued it at 1.1x. 45% of that is $2,475,000. So that's what the gross intangible value is for the two senior partners. The accrual basis equity runs about, in most firms, about 25% of volume, 20 to 25%. If you're below 20, you're extremely efficient in your cash flow. And I've seen firms that are as high as 40 and 45%. So, but the average that we see is around 25%. So in this case, that's $1,250,000, and 45% of that is $5,662,000. So what happens year one? Remember now, go back to where we were with how much capital we have available. we got $450,000 to work with. We got to pay off the accrual basis capital in the first year, and five years of $2,475,000 a year is $495,000 a year. So this first year in this current plan, the firm's going to be negative cash flow of $608,000. There's only two ways that we can finance that. One is borrow money, which obviously would have to be the case in this case due to the size of it, or we would have to, obviously the partners would have to take a cut and pay. Neither of those is going to be very acceptable, and it's the reason why, in this case, the younger partners were balking. Carrying that out further, in years 2 to 5, we still have the same $450,000 to work with. Now we don't have to pay the accrual basis capital. We still have to pay $495,000 a year in buyout payments, and we still have $45,000 of negative cash flow. So not only do we have nothing left over for the remaining partners, we're actually still borrowing money or taking less compensation to do this. Obviously, this plan doesn't work. So the quickest, the easiest thing to look at would be to stretch the payments for the capital over 5 years and stretch the payments for the retirement over 10 years, even if we still use a 1.1x multiple, which I believe is probably high, and in this case is significantly too high. We can still see how if we can make this work. So in years 1 through 5, we still have that same $450,000. Now we're paying the accrual basis capital at the rate of $112,000 a year, and the annual buyout's now been cut in half to $248,000 a year. So now we've got at least $90,000 of positive cash flow in the first 5 years. I don't think that's adequate. I think the only way in this case that could be made really adequate is by reducing the multiple. But you can see at least we got to positive territory. And then in years 6 through 10, you know, the number becomes a little more acceptable at $202,000 of remaining capital. So the problem that Elder and Golden had was, and it's one that we run into all the time, equity never meant anything. It wasn't ever used for anything. It wasn't used for determining capital that way. I mean, they had to if anything ever really got bad, but for the most part, it's consensus driven, which is the way most firms operate. So they never adjusted it. So the beginning capital, which was set at a rate that was what the new partners could afford at the time, the $100,000 you recall, you know, that's why they got 5%, because the $100,000 felt like the right number, and they never ever adjusted it. So the firm just, equity means something. The firm grew from $2 million to $5 million with this equity allocation. The younger partners don't feel it's fair, and now they can't figure out how to bring in the new owners, because to even give them 5% ownership, as you recall, would cost $350,000 each. So how could they have done this differently? This is a technique that I'm using increasingly in situations like this, both in terms of how to build an agreement initially, and most importantly, how to change an agreement so that we now have one that we can bring in new partners in a better manner. And it's called the AAV, or unit method. We wrote an article for the Journal of Accountancy, which was published in December of 2015. Which describes this in significant detail. In this method, we establish units that are tied to the revenue of the firm. $1 of revenue equals 1 unit. It doesn't mean that we're actually valuing the firm at one times, because we can value the units at a different percentage. We can value the units at 80 cents a unit or 75 cents a unit, but we establish the number of units based on the volume. So if I've got a $2 million firm, I've got 2 million units. If in the next year I grow to 2.1 million, I create 100,000 new units. And so I've got to decide, how do I allocate, when I adopt this method, how do I allocate the beginning units based on where we are today? And then how do I allocate growth? And then as we pay partners out, how do we allocate the units that are reacquired based on the buyout? All of those represent opportunities to recognize performance, recognize value, recognize fairness in a way that's different than if we're locked into an equity method where all we can do is change the percentages and then let the formula sort of take over. So going back in time, if Elder and Golden had adopted this technique in the beginning when they admitted Younger and Eager, at the time the firm was $2 million in revenue. I would have recommended that at a minimum they allocate all of that revenue, those current units, to the current partners who had built the firm up to that point. So a million units each. An alternative to that might have been to recognize some of the past efforts that Younger and Eager had put into helping them grow the firm to that point before they became partners. So it's not unusual for us to give some nominal allocation for new partners for past efforts, and maybe we allocated 50,000 or something units to each of them. But we would have started off with where we were. And then that $3 million of additional growth that Younger and Eager clearly had a part in helping create would have been allocated differently than 45-45, 5-5. So let's just say we allocated it equally. I mean, that's just, I'm not saying that would have happened or should have happened, but just as an example, what would have happened had we allocated the growth equally? Each of the two senior partners would have been allocated $750,000 of that $3 million in growth over the years, and Younger and Eager would have been allocated at $750,000 each as well. Senior partners are bought out, and we're a $5 million firm. We're allocating $1,750,000 of units to the two senior partners, the $1 million they started with, now in the $750,000 they were allocated. And if we go back, let me go back here for a second to that slide. The other thing would have happened if we'd still had Younger and Eager pay in $100,000 for capital, we could have given them a higher percentage of ownership because we would have allocated all of that to the tangible value, which at the time was only $250,000 or $200,000, I'm sorry, $500,000. So they would have acquired more of the tangible equity, and they would have shared in the growth of the firm. So now Younger and Eager each own 20% of the firm, and Golden and Elder each own 30%. So the 30% is worth $375,000 of the total tangible equity, and their AAV units are $1,750,000. Now, obviously, Golden and Elder are being paid less than they would have been paid under the old method, but there's a sense of fairness in this. There's a sense of sharing that wasn't present in using the equity method. Now we come back. What do we do with the new partners we're trying to admit? We basically go through the same thing. We've got $1,250,000 of tangible equity. We sell each of them 10% of that for $125,000. And that can go either into the firm as a capital contribution if they need the cash, or it can go directly to the other partners. They're not typically going to be allocated any of the initial units that are in place. And then as we buy out the two senior partners, we're going to buy out 1,750,000 units from each of them. If we do it over 10 years, which is what normally would be recommended, that'd be 175,000 units per year. As those 175,000 units come in, those get allocated just like growth. So if the firm continues to grow at the rate of 100,000 a year, and we have this buyout at 175,000 units per year, we're allocating 275,000 units to the existing partner group at that time. So, you get basically rewarded for your sweat equity. Your sweat equity is made up of helping the firm grow and being a part of the team that makes the firm viable during senior partner buyouts. The surveys tell us that the average partner buy-in for new partners is about between $120,000 and $170,000, depending on the size of the firm. What we typically see is that that's done over time. The bigger the number, the longer period of time, usually not more than 5 years. And so the key to that is making sure that, again, just like anything, to make it motivating, that the new partner is going to be able to generate at least enough additional income to cover that buy-in, and hopefully more than that. So think about, the whole package. How's the compensation system working? What's the expected compensation for a new partner? How's that going to grow over time? And then what's an appropriate amount of that growth to use for their buy-in? This is the best way to look at that. Normally the buy-ins are between 3 and 5 years. In a lot of small firms, the buy-ins being somewhere between 50 and 75,000. You want to make sure you've got some skin in the game for the new partner. They want to feel like they've actually made an investment, that they own something. So giving it to them oftentimes doesn't really create that. But you also don't want to make it so burdensome that they feel like they're actually going backwards. This is our last polling question, Nikki.
Okay. As Terry said, this is the last one. This one is, I believe our approach to valuing our owner's interest in the firm is, and you can choose here, fair and affordable, fair but you aren't sure you can afford it, not fair because it's too high, not fair it's too low, and of course the last option if you don't have an agreement. Give everyone just about 3 more seconds. If you haven't voted yet, you can do so now. And I'll go ahead and close the polls. So 59% indicated that last one, they don't have an agreement. 26% think it's fair and affordable. 13% indicated fair, but they're not sure that they can afford the buyouts. And then the remaining 2%, not fair, too low.
Not fair, too low. Must be sellers. So in terms of feeling like it's fair, but you're not sure you can afford it, I'd highly recommend you go through that affordability exercise that I went through earlier. And if it doesn't play out, then you've got a problem. You need to work on your terms. If it does play out, now all of a sudden you can build confidence, because most of us don't really know how to say it's affordable. It just feels like a big number. I don't care how big the number is. If you're going to be writing checks for $100,000 or $200,000 a year to buy a partner out, that feels like a lot of obligation. But if you've gone through the evaluation and you understand how it's going to get paid for, that should build the confidence that you need to feel like it's fair and affordable. Vesting. When is it appropriate? I use vesting almost in every agreement I'm involved with. The issue that the reason why you use vesting, and this is something as I help younger partners understand what we're doing with their agreement, they usually come around to understanding why we use vesting. It's not because we're withholding the value that they would normally be allocated from them. It's not like we're saying, yeah, you earned it, but not really. It's more about making sure that they're in place to execute the transition of the firm from the senior partners to the younger partners. If we don't have vesting in place, now all of a sudden they're building up, and it can undermine basically the long-term plan of the firm. The firm can't stay viable without young talent, and we can't have the young talent leaving. And it's unfortunate that we have to sort of hold that over their head, but it's the reality. And so vesting really is used, again, not to withhold value, but to just put it in limbo so that young partners aren't walking out the door prematurely. How long should it be? Vesting comes in 2 forms. Tenure, normally that's defined as how long you've been at the firm as a partner. I would say most of the tenure vesting I see is between 10 and 20 years. It's tending to go longer these days, so it's not uncommon to see agreements that say are 50% vested after 10 years and 100% after 20 years. That's not an uncommon deal at all. You have to modify that when you're bringing partners in, of course, that are older. So if you're admitting a new equity partner at the age of 53 and you've got a 20-year vesting program, you probably need to create an exception for him or her. Age vesting is normally what's the minimum age at which a partner can leave and still get retirement benefits. Generally, I see that age being between 55 and 60. It's not unusual, again, to see 50% vesting at age 55 with full vesting at, say, age 60 or 62 or even 65. And a lot of agreements have both tenure and age vesting in place. So it's a matter of creating a formula for how you deal with both of those vesting issues. When you're dealing with mergers, of course, this becomes a big issue in a merger. So how much credit do we give the merged in partners for, if they're entering our owner agreement, how much credit do we give them for their past service at their old firm? And normally we grandfather them, but then sometimes overlay with a special vesting program to make sure that they don't leave right after the merge because we thought they were going to be with us, which is why we merged them in. Governance, comes in the form of typically 3 levels. Normally, in multi-partner firms, we elect managing partners based on a simple majority of partner votes, partner equity. You got to decide: am I going to be a one-person, one-vote firm, or are we going to vote equity? I think one-person, one-vote tends to work better, except for supermajority decisions. The simple majority, if you want to layer over that certain kind of semi-major issues like expenditures over a certain amount, entering into a new office lease, those kind of things, simple majority votes work in those kind of situations. And then supermajority votes come into play for very important super decisions. And those generally run into selling or merging the firm, merging or acquiring another firm, admitting a new partner, terminating a partner. Those are the issues that tend to be subject to supermajority votes. And it depends on the makeup of your partner group, what the supermajority percentage should be, but it tends to run between 70 and 90%. I'm not a big believer in unanimous voting unless you have a firm that has 3 or fewer partners. Unanimous voting puts as much weight in one person's vote, even if they own a very small percentage of the firm, as it does in all the other partners that in the firm. So an extreme example, you have someone that owns 2% of the firm's equity, and they have as much to say as to whether or not a decision goes forward as the other 98%. So I try to avoid unanimous decision making unless, again, it's in a firm with only 2 or 3 partners. Mandatory retirement ages, should you have one. I generally recommend you do. Otherwise, you are flying blind. You don't know when your partners are leaving. It's hard to build transition plans and build succession benches in smaller firms if you have no idea of the timing of partner retirements. And so if you can do it, mandatory retirement ages are recommended. Again, about 2/3 of most of the firms that responded to the IPA 2015 survey had a mandatory retirement age. Admittedly, these are tend to be larger firms. Additional information, these are webinars that are, I think are potentially relevant to the conversation we've had today that are on our website. And you can access those through our website, as well as all the other webinars that we presented. They're all recorded and are on there. These are some articles that we've written for the Journal of Accountancy. The first is a series of actually 12 articles that were published 12 months in a row, which deal with all the issues related to succession planning for an accounting firm. It's a pretty good series. There's another series we did later that year that are three months in a row that are related strictly to valuing accounting firms. And then I mentioned this final article on the AAV approach that were published in December of 2015. I also recommend that you access the AICPA Succession Planning Resource Center. That's a picture of my partner there, Joel Sinkin. And we had a significant part in developing the content that's on that website. We get a lot of calls from people who start there and end up calling us, so we recommend you look at it. I'm a member of the CPA Consultants Alliance. It's made up of, I forgot how many we've got now, I think it's 12 members. And you can see the list of those members here. We're all involved with providing consulting strictly to accounting firms. One of the things we just did was we published a book called Bridging the Gap. We all contributed to that book. I believe you can actually get a discount from this cost if you go to CPA Trendlines to order the book if you're interested. We've also got on our website white papers that you can download. We publish something every year. We've been operating now for 5 years. And so these are 3 of the white papers that you can download. You can also sign up to be on our blog and distribution list for information. Nikki, are there any questions I can answer real quick in the chat room that I can't?
Well, you know, Terry, it's just after 2, and we have to end the webinar in order to give everyone the survey. So I think it might be best to respect time and go ahead and close if you're okay with that. Okay.
Sorry about that. Here's my email address. If you have any questions you didn't get a chance to ask in the chat room, feel free to send me an email. Thanks for your attention.
Perfect. And if you did ask a question in the chat room, I'll make sure that Terry has all of those and he'll be able to address them. You'll receive an email about an hour. That'll also include links to all of those articles that Terry recommended, so you could take a look at those. If you reply to that email, you can be sent to me, and if you have any questions about CPE or anything like that, you could direct those my way. Otherwise, if you answered the polling questions and if you do the survey that'll launch in just a moment, I will email you your certificate within 10 business days. So Terry, thank you. Everyone, thanks so much for attending, and we hope that you'll join us for a future webinar.